Hello everyone, this is the quiz review video for your quiz on depreciation and plant assets. This is the chapter 10 quiz in Pearson. And the first problem we have Taquito Thursdays, and they purchased a new grill on January 1st, 2020 for $39,000. At the time of purchase, the company estimated the grill would have a useful life of 4 years or 8,250 operating hours, which one we use for useful life is going to depend on what method of depreciation we use. They also estimated that this piece of equipment, this grill, would have a residual value of $6,000, so we're going to sell it for at the end of its life. Over the next 4 years, Taquito Thursdays used the grill for the following amount of hours, which are listed in the table over there. We're going to fill in some depreciation tables to figure out what our depreciation expense for each year of this asset's life was. And we're going to start using the straight line depreciation method. So the first thing we want to do is account for this on the day that we purchased it, which was January 1st, 2020. And we paid $39,000 for it. So at the time that we bought it, we hadn't depreciated this asset at all yet. That's our book value, 39 grand. Some of these tables will have a separate column that says historical cost. Just fill in the same amount as you would for book value in that column. At the end of the first period, we're going to have December 31st, 2020. We're going to start with our depreciation base, and that is our historical cost minus our residual value. Our historical cost we know was $39,000, and we're estimating this grill is going to be worth $6,000 at the end of its life. So $39,000 minus $6,000 gives you $33,000 depreciation base on this asset. In the straight line method, you, for the purpose of calculation, use the amount of years, the amount of time that you're going to have this asset for. We're going to have this for 4 years. Straight line means we're going to take an equal portion away each period. So if we take that $33,000 depreciation base and divide it by our useful life of 4 years, it'll give us the equal amount to take away each year during this asset's life in a straight line, if you will, for straight line depreciation. In this case, it's going to be 8,250 during 2020. Since that's the first time we recorded depreciation, our accumulated depreciation on this asset would be 8,250, and it's going to lower its book value. Book value is always historical cost minus accumulated depreciation. After we record this depreciation expense, we are going to lower the value of this grill on our books down to $30,750. On December 31st of 2021, the end of the second year that we had it, the depreciation base does not change, nor does the useful life, which means we're going to record the same depreciation expense as you should. Again, in straight line method, you take away an equal portion each year. So now our accumulated depreciation, we've recorded an $8,250 depreciation expense twice, which means it's up to $16,500. Reducing this grill's book value down to $22,500, the $39,000 historical cost, minus the $16,500 in accumulated depreciation we have at the end of 2021. And we're going to repeat this process for the third year, which is 2022. Depreciation base doesn't change. Useful life doesn't change, meaning we have the same depreciation expense. If we add that to our existing accumulated depreciation, it increases it to $24,750 and decreases the book value of this asset down to $14,250. 2023 is the last year that we're saying this is going to be useful, the end of its useful life. Depreciation base doesn't change. Useful life doesn't change. Depreciation expense is going to be exactly the same, increasing our accumulated depreciation to $33,000. And our book value now at the end of its life is going to be the $39,000 historical cost we had when we purchased it, minus the $33,000 in accumulated depreciation we have. That's $6,000. And we know our chart is good because when you get to the end of the life of the asset, the number that you have for book value right here should be equal to your residual value. We had a $6,000 residual. Our book value says it's $6,000 at the end of our depreciation table. Our table's good to go. The next method we have to make a depreciation table for is the units of production method. And unlike straight line, this doesn't account for time, it accounts for actual use. So we're going to start with our depreciation base. That's the same as we had before. It is our historical cost minus our residual value. Our historical cost on this grill is still $39,000. The residual value is still $6,000, meaning our depreciation base is $33,000. Well, let's divide that by the useful life of this asset. But since we're using units of production, it's not the useful life in terms of years, in terms of time. It's in terms of use. We think we can use this for 8,250 hours. So let's divide that depreciation base by our useful life in units, and we get a unit depreciation of $4. That means for every hour that we operate this grill, we should take away $4 from its value on our books. Obviously, you're not going to do this every day, but at the end of each period, you're going to have a log that's going to tell you how many hours you use the grill for. You're going to multiply that by your unit depreciation to figure out how much you need to depreciate this asset by for that period. For our table, let's still start with the date that we are acquiring the asset on. That's on January 1st, 2020. We bought it for $39,000. That's going to be our beginning book value. At the end of the first year, we're going to record all of the depreciation for that year. So to do so, we're going to need our unit depreciation. Well, we just figured that out. It's $4 for every hour we use the grill. How many hours did we use the grill during 2020? That's where this table comes in. We used it, according to this table, for 825 hours, which means if we're taking $4 away, or if we're accumulating $4 worth of depreciation for every hour that we use this, and we use it for 825 hours, we should be recording a depreciation expense of $3,300. And since this is the first year that we are putting depreciation on this asset, that's going to be our accumulated depreciation, reducing our book value to $35,700. Year 2, 2021, we're still going to have the same unit depreciation. We're going to multiply that by how many hours we used the grill for during that year. Our table tells us that we used the grill in 2021 for 2,475 hours. Well, if we multiply that by our unit depreciation of $4, we get $9,900. So if we depreciate this by $3,300 in the first year and $9,900 during the second year, it will have accumulated $13,200 worth of depreciation by the end of 2021. And that $13,200 worth of depreciation will be subtracted from our historical cost of $39,000 to decrease our book value on this grill to $25,800. Year 3, December 31st, 2022, we're going to make another adjustment for depreciation on the grill during the year, using the same unit depreciation and the number of units produced from our table, which is 3,300. Multiply those two together, and we're going to record a depreciation expense of $13,200. Add that to our existing accumulated depreciation. It increases to $26,400, lowering our book value to $12,600. And then in the last year that we have this asset, on December 31st, 2023, our unit depreciation is going to be $4. We used it for 1,650 hours during 2023, meaning our depreciation expense is $6,600. When we add that to our existing accumulated depreciation, we get $33,000. And if we take our $39,000 historical cost, subtract out our $33,000 of accumulated depreciation, we get $6,000 of book value at the end of 2023, which again is equal to our residual value, so we know that we're good. Word of warning, this particular set of numbers works out nicely, but keep in mind that when you say 8,250 hours is going to be its life, it doesn't mean you have to stop using it at the end of its life. If you used more, well, you wouldn't depreciate it past its residual value. You would leave it at that residual. So for some reason, if you go over the amount of hours that you were spreading this depreciation across, you just bring it down to its residual value instead of lowering its cost even further. That's an important concept to know when we move on to the next method of depreciation. And our next method of depreciation is the double declining balance method. So in the double declining balance method, you're going to start exactly the same. Take the date that you are acquiring the assets and put that asset on your books as its book value. In this case, we have a $39,000 book value on this grill. At the end of the year, we're going to depreciate this grill using the double declining method. What we're going to start is we're going to bring down our last known book value. We paid $39,000 for this. Excuse me. We haven't depreciated it yet, so our book value is going to be $39,000 at the time that we depreciate this. And we're going to multiply that number by our DDB rate, which is our double declining balance rate. And double declining balance is a form of accelerated depreciation where you just double the straight line rate. It's that easy. So here, our useful life was 4 years, meaning we should take 1/4 of our value away each year if it was straight line. We're going to double it to 2/4, or if you want to reduce fractions, 1/2. So 2 times 1/4 gives you this 1/2. And when we take our beginning book value of $39,000, multiply it by 1/2, we get a depreciation expense we're going to record during 2020 of $19,500. It's our first year, so that's going to be our accumulated depreciation, $19,500. We subtract that from our $39,000 historical cost that we started with. That is $19,500 is going to be our book value at the end of year 1. Moving us on to our second year, 2021. Our beginning value at the beginning of that period of 2021 is going to be $19,500. So literally just drag down what you ended the prior year with to start the next year. We ended 2020 with a book value of $19,500, which means we have to start 2021 with that same $19,500 book value. And we're going to multiply it by the same GDB rate of 1/2. 19,500 times 1/2 is 9,750. And when we add that 9,750 to our existing accumulated depreciation, it is going to raise the value of our accumulated depreciation account associated with this particular piece of equipment up to $29,250 and lower the book value of our grill to $9,750. On to year 3, 2022. We're going to begin this year with $9,750. Again, the same as our ending value at the end of the prior year. Let's multiply that by our DDB rate of 1/2, and we come up with $4,875. Well, if we add that to our existing accumulated depreciation, it's going to raise our accumulated depreciation account to $34,125, lowering our book value to $4,875. And guess what? We have a problem. What problem do we have? Well, we know that at the end, our table should always be equal to its residual value. Our residual value is $6,000. But right now, our depreciation table says that our book value of this is $4,875, below our residual value. This happens with the double declining method. So when you get to a point in the double declining method where your number is going to end up lower than your residual value, instead of using your existing double declining balance rate, all you do is you take and record an amount of depreciation expense that's equal to the difference between your beginning book value at the beginning of the year and your residual value. We started the year with a book value of $9,750. We know we need to get down to $6,000, which means we should depreciate it for the difference, which is $3,750. And when we do, it increases our accumulated depreciation to $33,000, giving us an ending book value of $6,000. So we've successfully plugged in our number. Our table ended up with the proper ending book value, which is equal to our residual value. But we still got a year left, 2023. So what do? Well, our beginning book value was $6,000. We just don't depreciate it. Easy enough. We record 0 depreciation expense. Our accumulated depreciation stays the same at $33,000, and we still have an ending book value at the end of the useful life of this asset, 4 years, which is equal to our residual value.